This is a paper from August of this year. It's a concession paper for TAX 3701. So this question paper was for 100 marks, and you were given 118 minutes. So that's about, yeah, however many hours. Looking at how the question paper is drawn up, you are allocated a number of minutes per question. So the first question is VAT, and it's 54 minutes. The second one is a normal income tax liability. That's the one that we're going to be focusing on today. Because we want to cover, remember last week we said we're going to be covering our general deductions. This question includes the capital allowances, recoupment provisions as well. So we're going to be going through our income, our general deduction formula, our specific deductions, and also allowances and recoupment as well. Then question 3 is your provisional tax. Question 4 is your general deduction, and that is worth 10 marks. And that is for 18 minutes that you can attend to that question. So as much as possible, try and stick to the guidelines of the time that is allocated to you for your questions so that you can finish your paper. So we will be going to question 2. We will go through each transaction, and then as always, we will be writing our memo as we go. So I have made some notes and comments for us so that when we begin our question, when we go through it, then we can address the stuff as well. Okay, so the required part of this question. It says that we need to calculate the normal tax liability for Lucky Naidu Manufacturing Pty Limited. So that tells us this is going to be a company calculation. It's not an individual. Even though the name sounds like it's an individual, it is a company, Pty Limited company. So now we need to look at the year of assessment. The end of the year of assessment is the 31st of March, 2025. Please, it's important to take notice of the year of assessment end date. This will be important for instances where you need to calculate the number of months for a specific amount. For instance, if they say you're renting a property, but it's from the 1st of June. So you will need to then calculate from the 1st of June to the 31st of March. Okay. Then they tell us, please provide a reason should an amount be exempt from normal tax or does not qualify as a deduction for income tax purposes. So here we need to explain when we are saying that the amount is not being taxed, and we also need to explain where there is why there isn't a deduction being allowed for a specific expense. So let us get into the question. The transactions are few, so hopefully we'll be able to get through the question together. Yeah. Then they tell us Lucky Naidu Manufacturing Pty Limited. From here on out, they'll be calling them LNM. Is a company that is that manufactures wooden furniture for the South African furniture retail market. LNM is a registered VAT vendor. So when we see the words registered VAT vendor, what should we already be thinking about?
That business is registered for VAT.
Yes. And then what will that mean for your calculation?
If it says exclusive of VAT, it will be 15/100.
And then if it's inclusive?
Come again?
If it's inclusive?
It's 15/115.
Thank you. So you need to always take note of whether or not the person is registered for VAT purposes, right? Then again, they emphasize the year end is the 31st of March, 2025. They tell us LNM is not a small business corporation as defined in section 12E. So what does that information tell us? How is a small business corporation taxed differently from a normal company?
Hello?
Hi, go ahead.
What's the question?
How is a small business corporation different from a normal company?
Maybe it's due to different tax rate.
Correct. So with the small business corporations, you will use the table, whereas our normal businesses, we would use our flat rate of 27%. And they also have their special wear and tear allowances that is applicable for a small business. But in this instance, that's not important to us. So we will ignore that. We will know that we will use our normal 27% for this question. Then they tell us that they are in the manufacturing activities and they have been approved by SARS as a manufacturing process. So this tells us that we need to look at specific allowances for a company that is in the manufacturing business. And that is specifically section 12 cap C, where we are told that you can claim your allowances using an accelerated rate of 20-20-20 over 5 years. And then if the machinery or the assets that you'll be using in the process of manufacturing are new and unused, then you can use the 40-20-20-20 percentage. So that is the benefit. And you will not have to apportion the allowance for the specific year. If you, let's say you bought that asset during that year of assessment, you can claim the full amount versus what you would have had to do when you were looking at section 11E. So you will rather apply section 12 cap C because it's more beneficial for the taxpayer. Then with the building that they would be using for the process of manufacturing, you can then claim an allowance for that building in terms of section 13, where it allows you to claim a 5% allowance per year. Okay. It doesn't mean that they cannot qualify to use section 11E allowances. They can still use section 11E allowances. It's just that when you're looking at the assets specifically used in the process of manufacturing, you would use section 12 cap C because it is more beneficial for the taxpayer to use an accelerated allowance rate. Okay. Then they tell us all amounts stated are exclusive of VAT unless specifically stated otherwise. Then now this is the calculation part. Then they tell us that the accountant provided you with the following information for the year of assessment ended 31 March 2025. Sales to the Southern retail market amounted to 17,289,328 rand. How would we treat that amount? Ladies and gentlemen, how would we treat the sales amount that they have received for the year?
We are not adding it as
We will
sales under our calculation of.
Thank you. So this amount you would include as your sales amount, 17,289,328 rand. This is worth 1 mark. Then further, they tell us a story with regards to this sales. They tell us that included in the is 18,250 rand relating to sales made on the 1st of June 2024 to a customer in Durban, South Africa. LNM was notified on the 1st of December 2024 that the taxpayer has been liquidated and will not be able to recover any portion of that amount due to them. How do we treat this amount?
We then write it off as bad debts.
Yes. So this amount would then be included as part of bad debts, specifically in terms of section 11 3701I, bad debts can only be claimed if that amount was included as part of your sales during the current year or a previous year of assessment. And then the only time you can claim that amount is if that amount specifically went bad during that year of assessment. So we can then deduct this 18,250 Rand from our sales amount. So it will be deducted from there. And that is with another mark. Okay. Then they tell us we have cost of sales for the 2025 tax year. And this was calculated as follows. Opening stock on the 1st of April 2024 amounted to the market value of 3,328,325 Rand. How would we treat our stock?
We deduct the law of cost or market value if there is cost, but here there is no cost. The amount of 3.328325 million will be fully deducted.
Thank you. So because they said to us we must give them a story, so we use the lower of market value or cost. In our case, we only have the market value. So for market value used, yeah, MV. Okay, so we will deduct the 3,328,325 Rand, and this will be with 2 marks. And this is because you gave them the story with regards to the lower of your market value or the cost. So in this case, we would use the market value because that's all we have. Okay. Then they tell us that we had purchases from South African suppliers that amounted to 11,262,359 Rand. How do we treat this amount?
Fully deductible.
Yes. So section 11A would allow us to deduct this amount. It is, we use the cost that was incurred by the taxpayer. Here we go. Let me just, there we go. Yeah. So this is a simple mark that you would learn for yourself. Then they tell us the closing stock on the 31st of March 2025 amounted to 4,581,372 Rand. And the market value of the cost of the same closing stock was 4,631,251 Rand. What is the treatment of this one?
We add back the lower of cost or market value, which is the lower each. The lower is our market value. Therefore, we add back the market value of 4,631,000.
Let's just confirm the amount. Okay, let's just confirm. So they said to us that the closing stock amounted to that 4.5, and then the market value is 4.6. Which one is the lower?
The 4,581.
Okay, so it would be the cost in this instance, right? In the first instance, we had only the market value, so we used the market value. In this instance, the lower amount is the cost price, so we use the cost price of the closing stock, and that is with 2 marks. Again, so these are your low-hanging fruit marks. This, everyone should be able to go and attain those marks. Okay. Then under note 3, they tell us that the staff costs for the 2025 tax year comprised of the following. Salaries and wages amounted to 572,350 rand. How do we treat our salaries and wages?
Fully deductible salaries and wages.
Thank you. So if they had wanted you to give them a specific section, what section would you have used? Section 11A, your general deductions, right? Okay. So then they tell us that the company contributes towards the pension fund for all employees, and this amounted to 192,926 rand. And this is also a low-hanging fruit. We deduct that amount as it is, and this is worth the mark. Then they tell us that there was an annuity of 25,000 paid to the widow of the former employee who passed away during the 2025 year of assessment. How would we treat this 25,000? Any guesses?
We exclude that.
Why? Remember, they said when you are excluding something, if you say it's not deductible, you must give us a reason why.
It's not an expense in production of income, maybe.
Okay, that's a good argument. I like it. Anyone else want to say something else? Yeah.
The widow is not an employee of the company.
Okay, that's a good argument as well. So there is a provision in section 11, specifically in paragraph M, where it tells us that you can actually allow the deductions for any annuity that was paid to a former employee or a beneficiary of that former employee. So SARS understands that it does happen that the employer will pay an annuity towards the beneficiaries of a former employee who might have passed away. And it would be unfair not to give them that expense, because if the person was still alive, you would then allow them to deduct the salary and wage or whatever expenses that would have been incurred in relation to that employee. But now, because the person has passed away, SARS and Treasury are generous enough to allow you to claim that expense in terms of Section 11M. So this is a specific deduction that has been provided for in the Income Tax Act. Is everyone happy with that? No problems there. Okay. So I'm just going to put the section there so that everybody is aware of that. Okay. So then they tell us that LNM paid an amount of 300,000 rand to J. Plank, the chief furniture designer, on the 1st of February 2025, when he resigned. The amount was to restrain J. Plank from competing with LNM for a period of 2 years from the date of his resignation. The amount was taxed in the hands of J. Plank. How do we treat the restraint of trade?
We need to, we're gonna take 300,000 divided by 3 or 2, the less of the amount.
Correct. Thank you for that. So we take the lower of 300,000 divided by 2. And what is the 2?
2 years.
And then the 3?
It's it's 3 years.
When does the 3 come?
Because they say
Huh?
if it's lower than 2 years, we can calculate it by 3 years, and then if it's more than 4 years, we can use the 4 years. That's how I understood it.
Okay. Okay. So the act actually says you will use either the number of years that the person is restrained from trading, or you would use 1/3, and that's why you have the divided by 3. So it's the 1/3 actually comes from the act. It's not something that they made up. It's something that the act actually tells you to go and do. Okay, so that's where it comes from. But well done, thank you. So in this instance, we would use 100,000 as our deduction for the restraint of trade. Okay, 2, 3, there we go. And the 150 will just sit here. So it's not that you lose that deduction. You will still have that deduction available to you in the following year. So you can then claim it over the number of years that the person is restrained from trading. Okay. Make sense? Happiness. So then they tell us that we had incurred legal costs during the 2025 year tax year. The first legal cost that we incurred was 15,250 Rand. This was paid to M. Mkhize attorneys for collecting outstanding debt. Can we deduct this amount?
Yes.
On what basis? Why can you claim it?
It was not incurred in the ordinary operations of the company. That's why we must take this amount into account.
It was not incurred. Is that what you said? It was not incurred.
It was incurred.
I'm saying it was.
Okay.
I'm saying it's actually incurred.
Oh, okay.
In the ordinary operation of the business. That's why we are taking it into account.
Okay, cool. Just making sure that's what you said. Okay, cool. It is incurred in the ordinary operations of the company, and that's allowed. Okay. Or else you would not have your debtors paying you. Okay. Then they tell us that there's 6,500 Rand that was paid to Al Mola attorneys for collecting outstanding staff loans. How would we treat that one?
It's not what do you call it? But it's not, because it's not in the daily operation of the business.
Thank you. So we would not allow it, right?
Yes.
Operations. That's not allowed. Okay. Could also say that it's not in the production of income. Okay. Yes. Yeah, I thought I heard somebody saying something. Okay, then they tell us that the LNM had the following learnership agreements in place for the 2025 year tax year. The first one, Kane Ruli is in possession of a NQF level 6 and entered into a learnership agreement with LNM on the 1st of June 2024 for 2 years. Kane Ruli has a disability as defined. How would we treat this?
We then allow it as a deduction.
Okay. So what are you deducting? They didn't give you an amount.
It's NQ, it's not 20,000 for NQ level 6.
You're almost not there yet. Keep guessing. Remember, there's also the fact that this person has a disability.
Maybe 40,000, let's increase by 20.
For a learner with a disability, it's 60,000.
Correct.
The annual allowance.
Thank you. So then they tell us this took place on the 1st of June 2024 for 2 years, right?
It's apportionment.
Yes. For how many months?
I don't know. It's from which month?
And let's go back. They tell us that they entered into this agreement on the 1st of June 2024.
Oh, it will be from June until the year end of assessment.
How many months is that?
I don't remember. The year is March.
Yeah, year end is March.
June, July, August, September, October, November, December, January, February, March. 10 months.
Yeah. Thank you. So we take the first person. Julie, and we take the 60,000 because they have a disability. Divide that by 12, multiply that by 10 months. Yeah. So that would give us an amount of 50,000 rand that we can deduct. Yeah. That's the first one. And this is with 2 marks. Then our second story, they tell us that P. Mahlangu is in possession of NQF level 8 qualification and entered into a learnership agreement with LNM on the 1st of September 2023 for 3 years. P. Mahlangu does not have a disability. How would we treat this one? What is the amount?
Is 20,000.
Correct. Are we apportioning this one?
More than 2 years, there is no. It's more than 2 years, there is no apportionment. There is no array. We are not apportioning it if it's more than 2 years.
All right. So P. Mahlangu, there's no apportionment for this year. Mahlangu, and there's 20,000 rand. Okay, let's put it here, 20,000 rand that we are going to be allowing. And this is a 1 mark only. Okay. Then everybody comfortable with that? We're moving on to the next one. They tell us that we incurred expenses relating to repairs and maintenance during the 2025 year of assessment. L&M replaced damaged floor tiles in the reception area of the factory, costing 67,275 rand, including that. How would we treat the repairs of the damaged tiles? Can we claim repairs and maintenance? Any guesses? It's okay to be wrong.
Yes, we deduct.
Yes. And how much are we deducting? Remember they told us that they incurred the cost of 67,275 Rand, but in bold, they even put it in bold, including VAT. What do we need to do?
You must exclude VAT.
And how do we
First.
exclude? How do we exclude the VAT?
We say 67275 times 100 divided by 115. Then we'll arrive at the amount. Exclude
Thank you.
VAT.
Thank you. Repairs of tiles. 7,275. Yeah. And that would give us an amount of 5,500. Okay. And this gives us a mark. Yeah. So because our repairs and maintenance of the tiles is not it wouldn't be viewed as an improvement or capital something that is adding on to the capital, so we would actually allow that as an expense. It doesn't have an enduring benefit when we look at the tiles. Because of the damage that took place to the tiles, we needed to repair them so that we can get it looking in the same position that it was in before. They don't have to use the exact same tiles that they had before, but they need to just make sure that it looks good so that they can continue working in that space. You're not allowed to claim your repairs on damaged assets or even on your repairs on your buildings if you're using it in the production of income. Okay. So then they tell us L&M had to build a foundation costing 75,000 for a new manufacturing machine bought during the 2025 year of assessment tax year. How would you treat it?
So you mean the assessed loss?
We are here by the building.
Donation.
Oh, we are building
I'm
foundation. You are going far. Come back. We are still here by repairs and maintenance. So repairs and maintenance, they build a foundation of 75,000 Rand for a new manufacturing machine that was bought during the 2025 tax year. How would
this
we
one
treat
is, which section is 12C? Because I don't remember. I'm confused by 12E. Because this is not a small business corporation. This maybe, I'm not sure, maybe it will be maybe 100% annual allowance.
100%? Why 100%?
Or is this one is new? This maybe if it's new is 40% during the first year, and the last 5 years, the last 4 years it will be 20. The last 3 years it will be 20, 20, 20.
Okay, cool. That makes a lot of sense what you've said. Have they actually told us that the machine has been brought into use?
Sorry?
Did they tell us that we brought that machine into use during this year? Or did they just say that we bought the machine?
They're saying new manufacturing is new. This machine is new. Because the machinery is new, will claim 40% in the first year.
But did they use the machine?
They're
No,
saying
they
it was
haven't
not
used the
used. It
machine.
bought during the year.
Yes. The other lady is also correct. There's a hand from Raymond. You can go ahead.
Oh, sorry, ma'am. I wanted a clarity on this one. This is a cost of a foundation, right? Not of a
Yes.
machine.
Yes.
A foundation. Okay.
That's correct. So there's a provision in the Act where if you are you build the foundation for a specific machinery that you're going to use in your process, then you can claim that as part of the allowance for that specific machine. But in this instance, we don't actually get told that that machine is being used for the process of manufacturing during the year. They just say that they bought it. Yes, they bought it, but they don't say that they're actually using it. So this cost of the foundation, you would include it as part of your calculation for your capital allowances for that specific machine. You wouldn't claim it alone, standing by itself, this cost of the foundation. You need to claim it as part of that capital allowance for that machine. So in this instance, we would not be able to claim this foundation because it's a capital that you are now building. It's something that is got an enduring benefit, and you can then claim your capital allowances in line with that machine that you'll be using during the process of manufacturing. So we cannot claim this foundation because we didn't use that machine during this year. Okay. Does it make sense? Guys, if you're lost, please let me know. Don't keep quiet because I won't be able to help you if you don't speak to me. Capital in nature. Or claim the So for this year, you do not know if they brought that machine into use, so you cannot claim it. Okay. Happiness.
Happiness.
Thank you. Then they tell us here that you made a donation. L&M made a donation of 450,000 Rand to Safe Haven, a public benefit organization, and they received the Section 18 Cap A income certificate on the 15th of March 2025. How do we treat our donations?
We need to multiply that amount with 10%.
Which amount?
The 450.
Okay. Why? Why the 450?
Because the 450 is the amount that was donated.
Okay.
But
But
we
then
can...
why are you timesing it by 10%?
Oh.
Maybe we'll multiply 10% by the taxable income before donation. Then we limit that amount to, if the amount is more than 450, then we limit the amount to 450.
Correct. 100% correct. So it's 10% of your taxable income before you deduct your donations. So this will have to come back to it. So when you are doing your exam paper, this one, you put something there, you earmark it, or we're gonna come back at the end when I'm done calculating my taxable income, because I still have other information that I need to attend to. Then this one, I must come back to it at the end of my calculation. So the fact that they put it at number 7 is so that you can quickly go and multiply by 10% and get it wrong. So you must wait and come back to it at the end. Okay.
Alrighty.
Alrighty. Okay, and then if you find that your 10% is less than the 450, what happens to the difference?
You claim it in the next year of assessment.
Correct. So you will just carry it over to the next year of assessment. Okay. Then they tell us that L&M has an assessed loss of 250,000 Rand brought forward from the 2024 year of assessment. How do we treat the assessed loss?
We are not carrying it forward to the current year of assessment. And
Why?
maybe they are saying this assessed loss. Oh, they are saying assessed loss brought forward from 2024 year of assessment. Oh, it's already brought forward. Then maybe we must fully deduct this 250,000 from. Yeah, it will it will be fully deductible during the year of assessment. Yeah.
And where do we put it in our calculation? Do we just plug it in now?
Maybe we must put it maybe at the end before our tax liability.
Okay. So we are going to come back to it again. We're going to highlight it so that we can come back to it. Technology, work with me now. Okay, there we go. So we're going to come back to it, right? So this also comes to the end. Which one comes first before, which one's first, the assessed loss or the Section 18A deductions?
Donation come first.
Why?
I don't know if it's
No, I think the loss has to come first because we need to calculate the donation with the total amount of what we've calculated.
Yes. So that we need to use the 250,000 Rand before we calculate our limitation for our Section 18 Cap A. Okay. So it's assessed loss before Section 18 Cap A. Awesome stuff. So these two, we're going to come back. We have earmarked to them, and that's why they are orange. We're going to come back to them. Then they tell us in number 9, L&M has the following capital assets for the 2025 year of assessment. They tell us L&M bought 4 new delivery trucks on the 1st of August 2024, for the total amount of 2,415,000 Rand, including VAT, and brought them into use on the 1st of September 2024. What provision are we using to claim this expense?
It's not Section 11E.
If I'm asking you, you're asking me.
Oh, it's Section 11E.
Thank you. So we use Section 11E. And then how do we treat this amount? What do we do first?
First, we must exclude VAT from 2415.
Yes. So we take the 2,415,000, multiply that by 100 over 115, tax fraction, and then that will give us the amount of 2.1 million. Yeah. Then we take the 2.1 million. And then what?
You divide by the number of years.
How
then
many
you
years?
Multiply. What the question
Let's go back. Let's see. It says there in note number 4, the bullet number 4, it tells us that the general ruling.
4 years.
Yes.
Yeah.
So we're going to use 4
divide
years.
by 4.
Yeah. So I hope everyone follows along. This is where we're finding the 4 years. It's from the general binding general ruling. Number 7, it tells us that we need to use the 4 years. Okay. And then are we done?
No, we must apportion it.
By how many months?
By 7 months. It's not from September, October, November, December, January, February, March, yeah, 7 months.
Yeah, thank you. So that will give us 306,250 Rand. There we go. Then we can deduct it there. Okay, and that gives you your first mark is for first excluding your VAT, and 3 marks for the whole calculation. The divided by 4 multiplied by the 7 over 12 months. Okay. Then they tell us here that L&M bought a second-hand manufacturing machine X on the 1st of July 2023 for an amount of 380,000 Rand and brought it into use on the same day. Okay. Then they tell us, due to a power surge that occurred in the factory, the machine was damaged beyond repair on the 15th of April 2024. Okay, let's first deal with the first part, right? They tell us that they have this machine that they're using in the process of manufacturing. What are we going to do first? Do we have, yeah, actually, let's just start with what are we going to do first? What do we do with this information?
We must calculate the annual allowance that we're going to claim.
And what percentage are we using?
Well, this machine is second hand. We'll use 20%.
Thank you. So for this current year, 2025, we are going to calculate our wear and tear on that machine that cost 380,000 Rand times 20% because it's not a new or unused machinery. That's why we are using 20%. There we go. And we're going to do that for 5 years, or we would have used it for 5 years. And then we don't portion it, even though we stopped using it halfway through the year. We won't apportion this amount because Section 12 Cap C allows us to claim the full amount for the year. Okay. Then they tell us that due to the power surge, the machine was damaged on the 15th of April 2024. Then they say L&M's insurer paid an amount of 250,000 Rand out on the 2nd of May 2024. How do we treat this insurance payment?
First, we must calculate the tax value. Then we compare the tax value with the amount paid.
How do we work out the tax value?
We will take what's the cost? We'll take the cost minus the allowance of 76,000.
Okay. Tax value. Okay. Why 76,000?
Because we only claimed 76,000 for the current current year of assessment.
But is our tax value only based on our wear and tear for the current year? Or is it for all the years that we've had this asset?
It's all the years, but now, because now we only brought the machine. Yeah, it's all the years, yeah.
How many years have we had it?
From 1 July 2023 to 31 March 2024 is 1 year. Yeah, it will be 2 years, yeah.
Yeah. So we need to then work out our wear and tear for 2024 as well. But we won't be able to claim that amount as part of our expenses for the current year of assessment. We're just doing this so that we can get the tax value. That's why we are doing this calculation. So we would minus the 76,000 from our current year and then our 76,000 from the previous year. And then that would then give us our tax value of, let's see. 228,000. Okay. 228,000. Okay. Then what do we do next?
We compare this with the amount we received from the insurer to determine whether it's a recoupment or a scrapping allowance.
Yes, thank you. So we have 250,000 rand that we received from our insurance company. So we take we can already see this as recoupment. Okay? Recoupment, 250,000 rand minus the tax value of 228,000. And that gives us an amount of 22,000 rand. Okay. Then do we just stop there?
No.
What's next?
We must limit this recoupment.
To what?
So the previous allowances previously claimed.
Okay, great. And that is only 40%, right? Times 40%. And that would then give us the amount of 8,800, right? So we would then include this as part of our taxable income for the year. Okay, so we would get a mark for doing this calculation, but not claiming that our wear and tear for this current year. We get a mark for our wear and tear for the current year of assessment. We also get a mark for determining our tax value, for stating what our insurance payment is, then determining our recoupment, and you also get a mark for limiting your recoupment amount to the actual allowances that were granted in the previous years. Or, yeah, previously, not previous years, but previously. Okay. So just from that one transaction, a person would have gotten 6 marks possibly. All right, yo. Then they tell us that they bought new manufacturing machine Y on the 15th of May 2024 for the amount of 632,000, including VAT, to replace the second-hand machine X, and brought it into use on the 1st of June 2024. And then they tell us the story. The foundation cost incurred of 75,000 was for machine Y. So how do we treat it now?
First, we must calculate the cost price by excluding VAT on the 632. Like we'll say 632, 500 times 100 over 115. Then we'll arrive at the amount exclude VAT.
Thank you. Times 100 over 115. That will give us 550,000 rand. And then what do we do next?
From there, we must calculate our annual allowances.
Why? What happened to this guy here? They told us the second part in the story here. They said the foundation cost incurred of 75,000 rand that we spoke about under repairs and maintenance was for this
then
machine.
We must add the foundation cost to the cost price.
Thank you. Right. So we're going to take our foundation cost of 75,000 rand, and then that would give us our new total cost of this machine. Machine Y. Is now 625,000. Okay, then now we can then determine our annual allowance. How much is our annual allowance? What percentage are we using?
let's go to the question again. Is this a new machine or is the second hand?
Transport
The new machine times
times
40%.
Times 40%.
Thank you. That will give us an amount of 250,000 rand. Okay. That's one mark and another mark for determining the new cost price and then the wear and tear at 40%. Okay. Happiness? Everyone following along?
happiness.
Thank you. Then our next thing, they told us that L&M bought part of a new building on the 1st of October 2024 for the amount of 3.6 million, including VAT, and brought it into use on the 1st of November 2024 as additional office space. How would we treat this? Someone is speaking in the background.
We must first calculate the cost price excluding that.
Yes, you're right. So we're going to take the 3,680,000. You're very sharp with regards to the VAT being excluded. There we go. That will give us a new amount of.
Those are free marks, yeah.
They are free
I'm not
marks,
gonna-
you know. At least you're recognizing, or these are the free marks that you must work on. Okay, there's your free mark already. Then what do you do with this 3.2 million?
Then I must multiply by, it's 55% times 5%, then I'll arrive at the allowance.
Yes. Thank you. And the allowance would be 88,000 rand. So this is a commercial building that we are allowing the allowance for. And we use 55 multiplied by 5%. Okay. Any questions with regards to that? Everybody's happy? Okay, great. Then they tell us that they went on to sign a rental agreement on the 1st of July 2024 with HPC Property Rentals Pty Limited for a period of 10 years with the option to extend the lease for 5 years. The lease agreement was effective on the date that it was signed, which is the 1st of July 2024. The rental agreement stipulated a monthly rental payable of 27,600 rand, including VAT, and a lease premium of 185,000 rand. L&M also had to erect a manufacturing building costing 3 million on the rental premises. Construction then started on the 1st of August 2024, and the building was completed on the 31st of December 2024 at a total cost of 3.2 million and was brought into use for the manufacturing process on the 1st of January 2025. Okay, so there's quite a lot of things that's here. Let's deal with the rent paid of 27,600. What is our treatment of the 27,000? Am I still here?
Rent paid is not fully deductible.
Why?
Thank you for asking why.
Sorry, I didn't notice that I was unmuted.
Why? It's good that you're asking why.
I'm just confirming it. I'm asking, is rent paid not fully deductible?
Oh, you're asking me the question that I'm asking you.
Yes, I'm asking
Oh,
you.
okay.
Yeah.
Okay. So which amount are we going to use? The lady who said why, please help us. Because you and I are thinking the same thing. Tell us what we must do.
Not sure.
Try. They said the amount is including VAT. What is our first step?
We must exclude VAT
Okay.
and
I was
deduct
about to
the
say.
full amount. Yeah.
Exactly. That's always the starting point. You remove the VAT first. If they say there's VAT, you remove the VAT first, and you're a VAT vendor, you remove the VAT first. Okay. Then we have 24,000 rand exclusive of VAT. They tell us that they rented this property from the 1st of July 2024. How many months is that?
9 months.
9 months.
Thank you. So we are going to multiply that by 9 months. 9 months. Okay. And that gives us the total amount of 216,000 rand. See, easy 2 marks. Your rental paid. There we go. Done. Then they tell us that the rental contract or the rental agreement tells us that we have a lease premium of 185,000 rand. How do we treat our lease premiums? Are you guys still there? Hello. Okay.
We are
So,
here. Yeah, we'll
okay.
take the full amount of the lease premium, and maybe we'll divide by the total years.
Yeah.
The total years the business or the company used the property. Then after we apportion according to the number of months during the current year of assessment they used. Yeah.
Okay. So how many years is there?
It's 10 years.
Yeah. So we're just going to divide by 10 years. Yeah. Then how are we going to then determine the amount for the...
What about the number of months?
Yeah.
Number of months they used?
Yes, that's what I want to find out from you. How many months is it?
I don't remember. If you go to the question, then you can see the number of months.
Okay.
We
10
years.
It's from July.
And then the months?
It's not 9 months.
Yeah, it's 9 months. So tell me something. When you are determining your lease premium, right? They say to you, you have the option to extend it by another 5 years. Why are you only using the 10 years?
Well, then if it's like this, maybe we must use 15 years. Because we have option to increase to another 5 years.
Yes. So that is the number of years that you would actually have the right to use that property. That's why we use the 15 years.
If the number of years is more than, let's say the number of years is 30 years, then is where we are going to limit it to 25 years.
Correct. So had it been that they said that this person could use the property for 40 years, then they could only claim for the 25 years. They wouldn't be able to claim for the other
10 years.
15 years. Okay.
15 years. Sorry.
Yeah. Okay. So that's why we're using 15 years, because they have that option to extend the thingamabob. The lease, sorry. That's the word I was looking for. And that is with 2 marks. Okay. So you could have done it like this, or you could have said 15 times 12 years, then multiply by, not 12 years, 12 months, multiply by 9 months, then it would give you the 9,250 rand. Okay. Happiness? Any questions with regards to that? Like we said, you then limited to 25 years as well. Okay, awesome. Then they say to us, there was leasehold improvements in the agreement. They spent 3.2 million. The contract said 3 million. What are we claiming as our leasehold improvements? And for how many months are we going to be able to claim the leasehold improvements?
We claim, first we must use the lower of the contract amount. And which the other one?
The 3.2?
The expenditure, the total cost, yeah.
Thank you. And then what do we do with the lower?
Come again?
What do we do with that lower amount?
Then you must, if you divide by the remaining period of the lease improvement.
And how many periods is left? So they said to us, we started on the 1st of August and we were done on the 31st of December. We were only able to start using it on the 1st of January 2025.
Yes.
So out of the 15 years, how many months did you lose?
It's not. The thing of months is now is killing.
Excuse. So from the yes, it's 5 months that we've used to construct the building, right? So the 5 months will now be then removed from the original 15 years that we have available to use the property. So we would only be able to use this property for 15 multiplied by 12 less the 5 months, which would give us the 175 months. Okay. So we take our 3 million. Sometimes the numbers leave me. Okay. 4. Why 4? Let's go back. Something's off. We have August. Oh, wait, no. We signed the contract on the 1st of July. We signed the agreement on the 1st of July. So we need to calculate from the 1st of August, from the 1st of July, August, September, October, November, December, which is 6 months. So we are only left with the 174 months. So let me put a note here so that everybody understands why. From 1st of July 2024 to 31st December 2024. Okay. This is when we were not able to use that property. And then for this current year of assessment, we were only able to use it for how many months? From January, Feb, and then March. So it's only for 3 months that we've used it in this current year of assessment. Are you guys following? Whoa.
Yes.
Okay, awesome. So then we would have leasehold improvements of 51,724 rand.
You are not saying 3, not saying 3 divided by 12.
No, already, remember here, it's already months. This is months. We used months, we didn't use years.
Yeah, it's not years.
Because if we had used the years, then we would have not used the correct amount. That's why it's easier for us to just use the months. Okay. Happiness?
Yes.
Okay, awesome. So then, what happens to our 250,000 rand that we've lost? That we've into this building? What do we do with it? Do we just say, okay, you've lost it, bye? Did they not incur that cost? Hello? What did we do? 350,000 rand less our 3 million, because already we've been allowed the allowance of the leasehold improvements above. So the 250,000 is all that's left that we can actually claim our Section 13 annual allowance on. So we would take the 250 multiplied by 5%, and that would give us an amount of 12,500 rand. And that is worth 2 marks as well. Okay, happiness then. L&M received the following investment income during the 2025 year of assessment. Interest received of 35,750 on interest-bearing South African investments. How do we treat this interest income? Is interest income exempt for companies?
No, it's only exempt for natural persons. Then we must.
Thank you. Yes.
We must add the full amount.
Thank you. So we include the full amount. There's no exemption in this regard. Then we have gross dividends received of 108,500 rand from shares held in South African companies. How do we treat this gross dividends? How do we treat our dividends income?
We exempt.
Okay. So we include it first and then we exempt it. And that will give us 2 marks. And the reason why we exempt the full amount is because dividends that is from a South African company would have already been taxed in terms of the dividends tax rules. So that's why we exempt the full amount, because it's already been taxed. There was a withholding tax. Okay, then they tell us that there is gross dividends received of 75,000 rand for a shareholding of 5% in a foreign company. How do you treat this? our foreign dividends. Come. How do we treat it?
We must add the full amount, and also we must do the exemption according to the exemption. That one, it was 7 out of 27 times that amount.
Yes, correct. 75,000, then 75,000, multiply it by 7 over 27, and that would give us our exemption amount of 19,444 Rand. That is worth a mark, and that is worth a mark. No, that's worth 2 marks. Easy 3 marks. And that gives us, yes.
Why are we multiplying by 7?
7 over 27. Yes.
Yes, please.
Okay.
Please explain that to me.
All right. So in the Act, there's a provision that if you have income from foreign dividends, and if it's in relation to shares that you hold, I think it's the 5% story, then you should then exempt it only for the portion of 7 over 27. It's in the Act. It's an amount that they give it to you in the Act. In section 10. Yeah, in section 10I. Yes.
When did you use 25 over 45?
So it will depend on the number of the shareholding. Let's see. Give me 2 seconds. I will tell you what percentage it should be. I'm going to write the question. When would we use a different exemption rate? Okay. I will put the full story here.
Or maybe now you can look for it just before the end of the class, because we have a similar question on the assessment.
Okay, cool. I will do so. Let me just make that yellow. Okay, cool. I will do that. So then they tell us that we need to make our sum now. Now we need to do the sum, and I delete this empty line so that it doesn't give us. So we get the sum of everything that we've done. Interest received. Okay, this is the first amount. So that would give us our total of 3.3 million. And then remember we said our assessed loss, we must come back to it. Where is our assessed loss? There's our assessed loss. And we would take it into account before we do our section 18A deduction. So we will then include or deduct our 250,000 Rand. And then we would get a subtotal here. And that gives us an amount of 3,068,122 Rand. So now we need to do our calculation. Okay. So it is limited for donations. We limit limited to the lesser of 10% of our taxable income before donations, and that is going to be the 3,068,122 times 10%. That gives us, oh, sorry, wrong column. That gives us 306,812. And then our actual donation was, let's go back and see that, 450,000 Rand. Okay. Actual donation is 450,000 rand. 450,000 rand. So the lesser of the two is the 306,812. Okay. Then we know that the remaining portion, remaining amount will be deductible or will be carried forward to the next year of assessment. Okay. Happiness. Is everybody still? Can you guys hear me?
Yes, we can hear
Yes, we
you.
are happy.
Oh, okay. I was worried that I'm lost by myself there. Okay. Then what is our tax rate that we're going to use for determining our tax, our normal income tax?
27%.
Yes. So we use 27%. And that would give us an amount of 745,554. Then they told us here towards the end that L&M paid provisional tax of 550,000 Rand for the 2025 year of assessment. So how would we treat that? Hello? How do we treat our provisional tax payment? Guys, am I still audible?
Yes, we are not subtracting it, the full amount.
Okay, thank you. I was worried. I went away. 550,000 Rand. And that gives us our normal tax liability of 195,554. Okay. So here we could have gotten a possible 54 marks if you had stopped at calculating your taxable income for the year. You would have missed out on these 2 marks. Yeah. So we need to always make sure that when we do our calculation, we answer the question that we are asked. Okay. Happy?
All the way.
Regards? All the way. Thank you. I like that. Okay. Awesome. So let us now go and look at our ratios. Not ratios, but the ratio exemption in terms of section 10 cap B3. It tells us here that a foreign dividends may qualify for the ratio exemption to the extent that it does not qualify for the other normal exemption. And here it tells us that the exemption is calculated using a formula that is A is equals to B times C. And the A represents the amount to be exempted for the specific year of assessment. B is the ratio. So this is where we want to see. Okay, so it will not depend on the percentage, but rather it will depend on the person. So if it is an individual who is receiving the dividend, a natural person, deceased or insolvent estate, we would use the 2540. I'm going to write it in here so that I'm not just speaking to myself. A is equals to B times C. And our focus is on B because that's where we want to see what ratio we're going to use. So we will use 25/40. If it is a natural person, a deceased estate, or insolvent estate. Okay. Then we would use 13 over 28, or I think because my thing is old, it would be different rates now. But let me just get the correct ones for the New Year's. So it will depend on whether it is an individual, it will depend on whether it's a company, or it will depend on whether it is for an insurance policy holder. And the rates will be then mentioned in the specific section. There we go. I see this one has different ones as well. Not sure which year this is. So you were asking about the 45%, but the 45% would be for the individuals. Does it answer your question?
Yes, Dino, thank you.
Okay, and then the 7 would then be for the company.
Okay, thanks.
Yeah. Okay, cool beans. That's why 25 over 45. And then 7 over 27. I've never seen insurance, but anyway, I'll put the company in there, and then the insurance one, it will be, I will get the correct one and then come and put it on. Okay. Happiness with regards to that. Somebody said it's part of your assessment.
Yes, I'm happy. Now I'm going to correct myself.
Okay. Okay, awesome. Okay, cool beans. So we still have some time. Everybody is happy with regards to the question that we just did. Can we look at the last question? It's worth 10 marks. It's supposed to be done in 18 minutes. So let's look at it. Let's see how far we can get with it. And then next week when we come together, then we can look at the other 2 questions in this assessment. Okay. Is that fine with everyone? Or do you want to ask other questions in relation to the question that we just did now? Let's look at question 4. So it tells us here, discuss with reference to case law, whether the medical expenses paid of 37,250 by Duma Courier Services Pty Limited will qualify for a deduction for normal income tax purposes for the year of assessment ended 31 March 2025. Okay, so we are looking at the company again, and we are going to answer whether or not the expenses that they incurred would form a deduction for normal income tax purposes. When you read the statement normal income tax purposes, what comes to your mind? Should come to your mind section 11A, the general deduction formula. So when we are answering this question, we want to then go and address this different elements in the section 11A formula. So let's go and read the information. It says Duma Courier Services Pty Limited, hereafter DCS, is a courier company with its head office in Johannesburg, South Africa. DCS has several satellite offices across South Africa and specializes in couriering medical supplies. DCS is a registered VAT vendor, and its year of assessment ends on the 31st of March 2025. Here's our story. On the 19th of September 2024, one of DCS's employee was on his way with a delivery to a hospital in Cape Town, in South Africa, from the satellite office in Paarl, South Africa. En route to the hospital in Cape Town, a vehicle skipped a stoplight and collided with DCS's courier van. The driver of the DCS van was seriously injured during this incident or accident, and being on a 3-month probation with DCS, he was not a member of DCS's medical aid fund for permanent employees. He was admitted to a private hospital on the 19th of September 2024 and was discharged on the 25th of September 2024. DCS paid the full medical expenses of 37,250 Rand, excluding VAT, to the private hospital on the 25th of September 2024. Okay. What are the elements of the general deduction formula? Let's start there. Question 4. Yell it out.
The amount must be actually incurred.
Okay, that's the third part. Actually incurred. Incurred. What's the first two elements?
It must be incurred in the
Expenditure and
production of
losses.
income.
Okay. In the production of income, somebody else was trying to say something. You can go ahead. I didn't hear you. Please go ahead and say what you said. Please don't run away.
Expenditure and losses.
Yes, expenditure and losses. Thank you. Expenditure and losses. What else?
Reserve assessment.
That are not of a capital nature.
Okay. Thank you. Not of capital nature, and you are also correct during the year of assessment. Okay. So we have 1, 2, 3, 4, 5, 6. Okay. So we're missing 1. What is the one that we're missing?
I'm not sure, but carrying on a trade.
100% carrying. So they must carry on a trade. Now comes the fun part. Now give me the court cases that we need to use to answer the question. What are the court cases? So what is the carrying on of a trade? What needs to happen in that place, in that specific element? What must happen? What does it mean to carry on a trade? Come, guys. We still have like 15 minutes. So come, let's go. Let's go.
It means the expenses must be part of your business operations.
Okay. So let's just talk about that element of carrying on a trade without looking at the expenses. What does it mean to carry on a trade? So when we're answering this, it means we need to look at
You are
what is
running the business.
and what is your business. So here you're actually addressing what is this person doing. Okay. So in this case, what were they doing? They said that they specialize in couriering.
Oh.
Yes. Correct. So that's what they do. That's the trade that they are carrying on. So we need to go and write that down. That Duma Korea. I hope you guys can see because it's small. Courier services. Specializes in it's not right, the spelling is off. Specializes in big words, medical supplies, and the trade is happening in South Africa. Okay, and therefore they're carrying on a trade. Before they are carrying on a trade. So that's the part that we needed to answer with regards to that element, right? So that is our discussion. Then now you need to go and look at the court cases. What specific court case would apply in this regard? So I'm going to write it here and you're going to go and do research on the specific court case and what is it that the court actually said and why is that the court case that we are bringing as our precedence for the specific element. Okay. So with this one, we are using De Beers holding, and it's for you to go and do research as to why. As you saw last week, I didn't share my cases with you guys because yes, I want you to go and look for the case itself and find the precedents that came from there. Okay. Then expenditure and losses. What is the specific expense or loss that they actually incurred? Must I go back to the scenario? They said to us that they incurred.
I wanted to say the medical bill
Yes.
that they paid.
Yes, thank you. So the expenditure incurred or the expenditure was the medical expenses of 37,000 paid to the private hospital, right? There we go. Then they tell us now we need to address the actually incurred. What does it mean when something is actually incurred? What needs to have taken place?
You mean actually incurred?
How do you actually incur something, an expense?
Paid.
So it's either you pay it or you have the obligation to pay it, right? The amount of 37,250,000 was actually paid by DCS to the hospital, right? So they actually paid that amount and thus it was actually incurred, right? So then they tell us we need to then test.
It means, actually incurred, it means you have unconditional obligation where you cannot go out of the obligation, like you are forced to pay.
What did you say? Sorry, I didn't hear you so well. It was breaking up a little bit.
I'm
Say it again.
saying this actually in CAT, it means the other party has a legal right to force you to pay, like you have unconditional obligation.
Yes, that's true.
Like Duma Korea's.
So it's either you've paid the amount to that person.
Oh, okay, yeah, now I get it.
Okay, so it's either you've actually went and paid the person out of your head, out of pocket, you gave them the money, or you need to go and pay that person. There is some sort of obligation on your side to go and pay that money over to that person. So they gave you a service, you now need to pay them for that service that they gave you. Okay. Then the next element is during the year of assessment. When did this actually take place? When did we pay this amount?
$25 September.
Yes. So the amount was paid to the hospital on 25 September 2024. Thus, which is during the year of assessment. And this is 2 marks, 2 marks, 2 marks, 2 marks, and 1 mark. Yeah. In the production of income, this is where the meat must come in. What is the issue here? Is this amount in the production of income? What would you guys say?
Yes, it is in the production of income.
Why?
Because the amount is directly linked to the business operations.
I like that. Anyone else want to say something different? Yeah. So the main issue is whether the amount of whatever the amount of 37,250 was incurred in the production of income. This is a mark, right? Then we want to address our court cases. So we said our court cases would be 2 marks, and this is where we use either Jaffe and Co, or we would use the PE electric tramway, right? So the principle that came from PE electric tramway, looking at my time, says that we need to look at what action gave rise to that expenditure, and is the action actually closely connected to the income. So we are looking at, as the gentleman said, whether it is closely linked to our business activity. How did this guy get hurt? Was he doing something else, or was this in relation to the business operations?
It was in relation.
Say that again.
It was in the relation with the business because the accident happened while he was on duty.
Okay, good. So rise to the experience. Okay. The driver was actually I want to say conducting the business operation, right? In the sense that he was out delivering a package for the company or on behalf of the company. Let's say that on behalf of the company when the accident occurred like that. Okay. So if it wasn't for that, if it wasn't for the fact that he was doing business related expenses, we couldn't say that there was a close link. If he had taken the car without the boss's permission and he was just going for a joyride and got into the accident, then we wouldn't expect that expense to be in the production of income, right? Okay. Then from Joffy, the principle there says that is the act of being involved in an accident inadvertible concomitant of the trade. The English is very strong here. So in English, in simple terms, is this something that could have been foreseen to actually have taken place because of the business that you're actually taking part in? So if I am in the courier business, it is an inherent risk of the company for us to get into accidents. It's something that we would expect to happen, and thus we would have insurance in place because we want to, we foresee that this could possibly take place while we are conducting our normal business operations, and that's why we see that as an inherent risk to the business. So in simple terms, is this something that we could foresee as a danger for our business? Yes, it would be, because we expect that our company, we are spending a lot of time on the road. Accidents do happen on the road, so it is something that is closely, again, it's something that is inherently related to the business activity that we are taking part in. Okay. Does that make sense?
Yes, it does.
Yes.
Career service business. There is an inherent, that doesn't look right, risk that the drivers could get involved in an accident, while performing their normal duties. Stop. Okay. So now we would have explained that portion, and then you must still conclude. Do we think that this is incurred in the production of income?
Yes.
Yes, it is.
Okay, so we can then say the expense is closely linked to the creation of the DCS, something like that. And thus, the amount is viewed as being in the production of, okay. So you need to conclude as much as you tell the story in regards to the court cases, you need to apply it to your scenario, tell your full story, and then conclude on the specific element that you are addressing. Then the last one is not in the production of income. Is this going to create an enduring benefit? No. The expense will not create an enduring benefit and thus would not be capital in nature. Yeah. So in conclusion, are we allowing this? Is this person going to be able to claim the medical expenses?
Yes.
Thank you. Will qualify as a deduction in terms of section 11. Oh, what did I do now? In terms of section 11A. 11A, general deduction. Formula. There we go. Okay, there we go. So this is where your big chunk of your marks are coming from. You could have gotten a possible 7 marks in relation to the story with the court cases, and then 2 marks for linking the your principles in the court cases to your scenario. And then you get 1 mark for concluding and 2 marks for determining that it's not of a capital nature. Okay, so there's a possibility of 19 marks that you could get, but the maximum that you should get is 10 marks. Marks and max is 10 marks. So you can get the marks in there some way. You just need to answer the question asked. And that is our session for today. I will share the slides and the 2 questions that we covered today with you guys. And then next week, we will do the other 2 questions on the paper. And we will also do another assessment type question. I hope this was beneficial for everyone, and thank you.
It was definitely.